Hi, welcome to Flux News Show. I'm Greg Newman, Group Chief Executive, Onyx Capital Group. I'm joined with Harry again, and Geek in the seat is Mita from the research team. So let's get straight into it. What's the temperature of the market? And we are saying it's hot, on fire.
On fire.
Yeah. So yeah, same as last week. Again, Mita, you were, as we were chatting before, you were kind of calling it not that hot. But what was the justification for that? Basically, Brent flat price, right?
It was. So, I mean, just talking from a flat price perspective, we saw a shock reaction, things tumble down. And then I will maintain that we did see a moment of de-risking over there. But with any risk assets such as oil, we do see risk picking up again. I think there was just this avalanche of tariff news out in the open. And I think there is just so much headline fatigue from that now.
That's true. So I know the outright price didn't move that much throughout the week, but the underlying was pretty on fire, right, Harry?
For sure,
The Brent spreads, cracks, everything's just like, in the way we define it as a trader, flows, like quite a lot of conviction out there.
Yep.
People making money. If you just ignore the flat price, which I know is not easy for people looking at oil, that's the only thing they really look at. There's so much more going on, right? And that's bubbling up.
Yeah, loads going on. Like refinery margins are on fire.
Yeah.
Fuel oil is on fire. Like high-sulfur fuel again, like all-time highs. Margins doing well. Like refiners making most of the like cheaper crude.
Good time to be trading, right? And again, for
Really
people looking
trading,
at oil, like we've had people in the US talk to us quite a few times. But again, they're just looking at the CL contract, WTI or RBOB. There's so much more, right? And that's what this is all about. There's so many more contracts to check out Onyx Markets.
Yeah.
And so much more, I think, easier ways to make money than a very volatile, prompt contract that people aren't very certain on. So
yeah, and lots of things that are moving. People are expressing views on these tariffs through like these contracts that we have on Onyx Markets.
Yeah.
Contracts that you mentioned last week, like FEICP, which had like a record move.
Yeah.
Like fuel oil cracks, which again are like all-time highs. Like Naphtha cracks have had a good move up. EBOB cracks have done well. Like everything's moving. Like everything's hot.
I think we should probably mention as well, like it certainly feels to me this was the impetus the markets needed for a while. It was getting stagnant. I mean, one big thing is the hedge fund. I've mentioned this a few times, but hedge funds all coming in as tourists to be long because investors didn't want to miss this whole commodity boom. These guys basically been in the market to be long gas, long power, long oil, and they've got pretty destroyed. Now, that's not a good thing, but it's good in the sense that, that lazy length that's propping up the market is gone. The markets can have a price discovery, more of a formal price discovery that makes more sense to the underlying physical. And we have seen a pretty decent kind of correlation to like real physical and supply and demand, which is kind of like healthy from a orderly perspective, let's say.
Yeah.
So let's move to what is driving the market and what we call the herd mentality. So what would you say, basically following on from what we just said, Mita, you're approaching it from the more, I guess, macro, outright price angle. What do you think is driving the herd from your perspective?
As you said, I completely agree. There's two separate sides. There's two separate herds, so to speak. One being the macro side, one being the oil industry itself.
Yeah.
So the macro side, as I said, commodities are risk asset. We did see a shock headline and risk immediately tumble from there. But now you see in different risk assets, the S&P 500 is picking up again. You see oil picking up again. It went from 58 to 65. So I do think risk is picking up again. And in terms of the headline itself that was driving this herd, that was the tariffs, that was the US-China trade war. But even then, I think, there's just every day is like a new headline. Every day is like everyone's confused about what's happening, what's the right timeline for this. And once you reach a point where that's 125% tariffs on both US and China, that's when trade just stops, right? Then you need to just figure out how trade balances.
That's when macro trading stops, right? So you've had a bit of stagnation because it's like, what's Trump going to do next? What's the tariffs going to be? They're on, they're off. So it's stagnated. But the industry, whilst seeing this, $15 decline in outright Brent and WTI, suddenly kind of realized that the underlying time spreads, the physical markets, the refinery margins are all actually very healthy. And it's almost like just went, you know what, I'm going to stop looking at that and just focus on this. So what is driving the industry herd, like you say? I mean, Harry, what would you say? I mean, generally like the physical market, right?
Yeah, I guess this might not be true, but it's almost like having this like big move, like you say, it was a bit stagnant for a while, and now you've got like a lower flat price environment and like a bit of a shock move. It's almost like traders have kind of woken up and been like, right, this is a good time to make some money. Like, what's actually going on in the physical market here? Like, what are our like fundamentals? Like, how do we ignore the noise?
I think I've got a thought on how to explain that as well. Like, I've heard some of the bigger hedge funds and even the bigger trade houses, because they have so much volume to move, like, or to enter a position and to exit. They can't just be like, oh, buy one day, sell another week or whatever. And they have to let the market come to them to even enter a position. And certainly the market needs to perform so they can exit. It can't just be a case of opportunistic, like sniping, because they've got too much volume to move. So what I think you could argue is, again, going back to the hedge funds and the macro money, it maybe shows just how much they were moving oil in 2024 and in like basically dictating flows in 2024, because now let's just say they're all losing money, which I think is a bit harsh to say, but I think the majority probably are, on the macro side, investing in oil. They are effectively giving the industry entry levels, because if they're all selling, like for example, and we'll talk about it in a bit, but selling the crap out of the time spreads, WTI and the Brent spreads, these are very physical linked contracts, but they're still futures. So there's a hell of a lot of volume, and the hedge funds are essentially either stopping out because they're long or they're getting short. And that gives an industry like a huge amount of liquidity to enter long when they're looking and seeing something completely different. But it's not just seeing something completely different. They're entering at low levels and they've got the physical to move, which will set the price for these contracts. And they're going, look, where the physical is and where the paper is, this is completely dislocated. This is a dream. I can get the liquidity on the paper at a great entry level, then make my moves on the physical. And it's going to be a great kind of leverage scenario. And I think what I'm getting at is when the hedge funds are competing with the trade houses for the liquidity to make money, it's a bit disorderly and people don't find it as easy. But when someone basically loses, as harsh as it is, it allows the kind of other side to do very well. And I think that's what we're seeing. I think that's in a nutshell what we're seeing.
Yeah, it feels like it, especially on like Dated Brent, which you track. You've seen like some like big moves there. It seems like people have been making money on Dated Brent.
For sure. And the Brent spread, you have to look at them intertwined.
And that's like the kind of where that intersection of the like macro money, industry versus like macro coming on the Brent spreads, and then it ties into Dated Brent. So
just to go over that quickly, because I know listeners out there are always saying like in English please and all that, and it's going to take a while, but just generally speaking, you trade the outright price in Brent and you trade, you know, some of the time spreads. You can look at that on a macro basis, right? It does behave generically with that macroeconomics, general supply and demand, but the time spreads in the very prompts, like the M1, M2, so right now the June, July Brent, that is very linked to, when it expires to a very particular physical or set of physical cargoes in the North Sea. So in other words, the few trade houses, you know, 5 to 6 trade houses who have real control over those cargoes, they are getting a huge amount of leverage from all the macro traders, from all the financial money, to trade that time spread, but it's very linked to the physical, which they have a very good idea on. So in other words, like you have to be very careful, but more importantly, you just need to know that it's not physical for the whole world. It's physical for the Europe and the North Sea. So you have to look at European refinery margins. Even if you're a macro trader in Asia, you have to know about Northwest Europe refinery margins, because they're the ones buying the North Sea oil, who are the one, and that is setting the Brent time spread. So I think that just needs to be explained. I know it's going to have to be explained 1,000 times, you know, because it's a new kind of newish concept, but it's ingrained in the whole pricing system of oil. To not know about it is pretty crazy. But anyway, sorry, I just think it's worth us keeping going over those. But yeah, your point is fair. So Mita, I guess anything else? I mean, you say there's fatigue in the China US stuff, I guess, and the tariffs, but there are still things being thrown at the market that they can't just ignore as well, right? Like the Iranian situation probably now.
Yeah, I think in terms of headlines now, I do think that we're gonna be supported at this level, and I think for us to be a lot more bullish, we're gonna need to see a lot more bullish headlines. Like for example, with the Iranian situation, we see there are talks.
That's quite a big statement, Mita. So you think it's going to be supported? Because the headlines, I would say, have been net bearish, no? I mean, the tariffs and all that.
But we do have the headline about the US and Iran talking about a nuclear deal. If that falls through, that would elevate prices.
But the fact that they're even talking in the first place is quite bearish, because you assume it leads to more oil supply. But I know what you mean, and then it falls through and then it goes bullish.
What I said. So what I mean is that I think with all the headlines being bearish, I think the market is still, I think sentiment is still going to see a ceiling, and we're going to need to see a lot more bullish impetus coming into the market for us to go back into the $70 handle, for example.
That's fair. I mean, it struggled even when it was there before all this stuff. That's a very fair point. And we've got now OPEC suggesting they're loosening supply out of nowhere. So yeah, I think that's a very fair point. But to just challenge that a little bit, like it does seem like Trump is very, very focused on oil, always is. He sees it as the barometer of the global economy. And whenever he takes away oil, I think they're looking at it quite, not simply, but in a straightforward way. Look, we think there's an oversupply, generally speaking. A lack of demand should cause, therefore, price dumps. But that means we can target someone we don't like and cut off their oil. So Venezuela and Iran. And they've been doing that, right? Every time there's a bear move, they go and attack Iran or go and attack them. That should probably continue as well, right?
So with the talks, again, I don't think anything is going to be solved this week alone, but like in the future, if these talks, because I think the alternative to them reaching a nuclear deal is the US attacking Iran, which would be a completely different ballgame for like sentiment. So that would be interesting to look at how this deal shapes up in the near future.
And I think to give value to the audience, right, where I don't think other podcasts are in oil particularly, Iran deal, what is that? How do we trade that? And you could talk about the outright price, but let's not. I mean, it's pretty generic. It falls through and they squeeze Iranians, price goes up because they can't sell their oil, and the reverse if they make a deal. But let's just ignore that. What do you think? Iran, what do we generally say? Ironically, it's a kind of a OPEC style Middle East sour crude, heavy crude, the Brent Dubai stuff.
It's kind of related to Dubai, right?
But then again, it's got a lot of condensate and it's very linked to Naphtha.
I was going to say Naphtha, yeah.
So what do we think? I mean, if let's look at the idea that Iran has got, usually have quite a lot of floating storage around. They're always kind of waiting to get back from sanctions in a way. Like if sanctions ever get removed and the oil can free flow, it's going to be Naphtha that gets hit pretty quickly. I would say, as a risk reward.
It might be worth saying to the viewers as well about condensate. It's like a very, very light crude, which doesn't even get refined usually. It just gets processed in something called like a condensate splitter.
Yeah.
And that produces a lot of naphtha. And actually the pricing of condensates is often linked back to naphtha as much as it is crude.
Yeah.
So in terms of a trade, you're looking at like a naphtha trade as much as you are a crude trade.
Exactly. No, exactly. And I think so there's a few things there. So Iranian oil back online, flooding the market, let's say, and going to get its market share. And when it's able to get market share freely, it's going to really lower their official selling price. It's going to really, like the Saudis sometimes do, start, pricing it lower than the benchmark grades and kind of flooding the market. So where are the main markets? Well, actually, historically, Europe as well. It's kind of the Mediterranean refineries. But let's just say it's going to add more oil to the Middle East region. So a proxy for trading the Middle East region is the Brent Dubai diff, right? So generally speaking, you're going to want to be long Brent Dubai, the Brent Dubai differential, if the Iranian oil comes back online. Now, a few weeks ago, Vincent was on here suggesting a long Q4 Brent Dubai trade. And I liked it because he was saying that, it's Q4. So as in like, he's deliberately put it down the forward curve, which means there's lower volatility because the prompt is the one, obviously, that's going to be more reactive to spot markets. But his general point was like, because the market is so stacked short, like for so long now, like 4 or 5 years, because OPEC have been in a state of perpetually cutting their production, they've, like trade houses, majors, even funds have been selling Brent Dubai or selling them rallies and kind of letting it expire weak. But because of that and because of what's changing, naturally it's stacked or the risk reward is skewed to the upside, because basically if these shorts now need to cover and buy just to cover their positions and new longs enter, that's an environment where you get quite aggressive rallies. So I liked it as a setup generally. We immediately, actually, after he said it, got quite a bit of volatility. But I think we can have a look at it. Could you whack up Q4 Brent Dubai? Yeah, so here we go. So actually, it was minus, I remember, it was minus kind of 20. We thought you could get the entry. So this is actually performed. Well, not exactly as we said, don't want to toot our own horn. But we said minus 20. You've had to ride a bit of volatility. We put the stop, I think, minus 50.
Minus 50 cents.
And it was a scale in around minus 7, minus 8, moving your stop up to minus 35. And then kind of letting it run and try to profit take around, I think we said 15 cents.
Like plus 10 or plus 15.
Yeah, so you're kind of getting towards that. It's not yet positive. Anyway, the point is that trade looked good anyway. Now, if it's on a trend, and maybe if you could zoom out a bit, Meta. So if there's a new trend being setting towards the upside, kind of found its bottom basically when it had a big sell-off, then look, you've still got the risk reward skew. It's not like the entire market's long now. We just had this like blip, I guess, relative to the long-term price action. And then you've got the potential for Iran to come back online. I love trades like this because if Iran doesn't come back online, nothing really changes and you're still in a trade that is kind of trending where you want it to go. And you liked it anyway from a risk reward basis. Yeah. But if Iran does come back online, that's going to really flood the kind of local region, which prices to the Dubai benchmark, which means the Brent versus Dubai differential needs to basically explode. And, normal levels for this, when I've been trading, crude for 12 years. And, the first 4 or 5 years at least, Brent Dubai was like between 4 and +6. Right? Yeah. That was really like a standard level.
From a specification basis.
Yeah.
It doesn't, it often that shouldn't make sense that Brent is cheaper than Dubai.
No, exactly. So this has been because of the artificial state of production, because OPEC have been cutting from 34-ish million barrels a day to 28. Mm-hmm. Yeah. We just don't talk enough about how much of a big deal that is. Mm. But anyway, if that now comes back to more normalized OPEC production, then you get maybe more repricing or a more general oil back. You got the setup for Brent Dubai to go back to at least $2. Mm-hmm. So that's another $2 rally per barrel when the volatility is on a 7-day ATR basis is probably 15 cents, max. Yep. So that's a huge move. You can talk about making, with a 50 cent stop, which is generous. Yep. You can make 4 to 1 easy. So that's, I think, what we got. I think for people who are looking at the US Iran situation, it's all well and good looking at flat price, but the Brent versus Dubai is set up for a bull run if Iran comes back online. Mm. If it doesn't come back online, I kind of think there's no real obvious trade because it's just a bit like the Russia-Ukraine situation, a lack of the ceasefire deal. It's we were just where we were before.
Exactly. Yeah.
Okay. And sorry, follow up what you guys were saying. What about the Naphtha?
So there would be a lot more Naphtha as well if Iranian crude is freely online for everyone and the sanctions are lifted. So then again, there'd be a lot of Naphtha and that'd be bearish, say Naphtha cracks because of that.
Yeah, and that would be that'd be a representation of global Naphtha, wouldn't it? Selling the Naphtha versus Brent crack. Mm-hmm. That's the proxy contract, right? And I guess what would you pick, the European or the Asia, which is called MOPJ, but go on.
Well, I mean, considering that there'd be a lot more Naphtha in the East as well, with Iran being there, I would say MOPJ maybe.
I think you're right. And I think, again, like the Brent Dubai, there's a good setup. Could you get up the Q3 MOPJ crack?
Yes. I think with Brent potentially being supported with the whole Brent Dubai thing, that would further pressure a MOPJ crack, which is interesting, I think.
Yep. So we were looking at the Q3 MOPJ crack with Toddy, I think it was last week, actually. Mm-hmm. We were pretty bearish this. And again, the general reasoning why was kind of similar to Brent Dubai, but in the inverse way. MOPJ crack have been held up very high for very long, and historically these levels are high. So I think we were looking at it around -3-ish. Let me look at the graph. Yeah, around -3. And we're saying look, that's got a long way to go to quotation marks normalize, normal levels being, $7 or $8 per barrel. Mm-hmm. So we said, look, let's put on the 200-day moving average as the stop. And I think that's roughly, $1.50. So you've got $1.50 per barrel leeway, which is quite a big stop. Mm-hmm. And we're just ride that because there'll be volatility in the way, but it's going to trend down and you've got it to go all the way down to $8 a barrel, which is basically 150% return. You could look at it like that.
Yep.
But the point is that, look, immediately as we said it rallied actually, and it's come back. But I think basically after coming off and coming back again. So it's kind of unchanged.
This is the volatility that you were expecting, right?
That's true. That's why you have a wide stop.
Yeah.
But again, to go back to this, a bit like the Brent Dubai, we want to be short this anyway. Mm-hmm. So if you want to be short this anyway, and then Iran comes back online, and remember, this is MOPJ crack. So that MOPJ is Mina Platts Japan. So it's just the benchmark for Asia Naphtha versus Brent. So then the condensate comes back online from the Iran sanctions, and then that floods the market in Asia for Naphtha, like you're saying, Mita. And so then this crack kind of needs to get hammered as a proxy for kind of global Naphtha and Asia Naphtha. And we wanted to be short anyway. Mm-hmm. So if anything, that just massively adds to your conviction.
Yep.
You could scale in that you probably were going to anyway. On that news, you could probably confidently sell more, or just like let it run with the wide stop like we talked about. So there's two pretty clear trades if the Iran situation unfolds.
Yep.
Again, if it doesn't, you're not going to lose much because, well, you still wanted to be short that. So it's not like you have, oh God, I've got to stop out. It's like you want to be short anyway.
Because the opposite happening is not an argument to go long that Naphtha crack at all. Like you said, it's just, it doesn't give you any clarity, so there's not really a setup. But yeah, you've got like a real asymmetric skew to the downside on this MOPJ crack now.
And again, it's I love these contracts that people are, oh, it's too random as well. You don't, like, it's good technical layups. It's not flooded with algorithms. You get these kind of scenarios which are just really, really good layups. I mean, where else do you see such good kind of layups like this? Anyway, that's the Iranian situation. I think we need to move now to the officials. And the reason why we're going to do this is we usually put them at the end. The officials are a publication arm. I'll let them describe themselves, but they focus more on the physical market. And given the physical market has more been kind of driving things, we think lately, I'm just going to plug into them by their desk, catch them not doing any work.
Hello.
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 Ed and Will. How's it going?
Good morning. Doing well. Very good.
Bursting with
So,
enthusiasm.
yes, we're the officials, and we're looking.
Yeah.
So yeah, we're the officials, and we're looking at pricing and the physical markets. So this week, the key thing is how the herd mentality, in a way. We're going to look at the banks' forecasts, the Chinese situation, and the Saudis' allocations and OSPs. So, Will, could you just take us through a bit of the kind of the herd is being led by the bank forecasts at the moment?
Yeah, so as has been highlighted on the podcast already, there seems to be a bit of a dislocation between what we're seeing in a lot of forecasters' balances and what we're seeing in the physical window. So, for example, Citi have recently revised down their oil demand forecast for 2025 to 400 kbd, and Goldman have done a similar cut to 300 kbd. So that's really quite bearish.
Just to give it
in the
context
physical
there,
window,
I mean,
things.
we were saying, you know, I think OPEC themselves were saying we're going to get a 1 million barrels per day increase in demand, which would justify the increase in supply that's going on, roughly about the same thing. And that was their justification to say markets are in balance. So the point is if you don't get that 1 million barrels per day increase in global demand, it's pretty damn bearish. So for them to be correcting to 400,000 barrels a day, that's quite a big swing, right? It's like a cargo a day overbalanced, which is quite a lot of cargoes. That's the general point, right?
Yeah, exactly. And a lot of this is driven really by demand destruction associated with tariffs. And you know, I think, you know, tariffs will have some detrimental impact on the demand outlook. But will we see this destruction? I think it's unlikely. In our global balance, we still have demand. It's about growing at about 1 million barrels per day. So we're not quite that bearish just yet. I mean, but it's not just the demand side that's driving these forecasts as well. That drives the supply and demand. What are you doing on the supply side?
Well, the supply side has had a few factors, particularly from the Saudis recently. So we've got OPEC's increasing or accelerating its return of barrels to the market from its voluntary cuts from May. And then the Saudis have cut their OSPs significantly for May.
Yeah.
And just now we've heard about the Saudi allocations to Chinese refiners for May. So these allocations are nominations of a certain amount of crude that Saudi Aramco will sell to refiners in China like Unipec or PetroChina for May, priced based on the OSPs, the May OSPs.
Yeah.
So on the screen now we've got this chart of the allocations that the Saudis have declared
into China.
And so the May allocation is the highest we've ever seen since we started the officials back in July last year. So it's jumped by, you know, 12 million barrels for the month. So that's a massive increase in supply going to China.
Yeah, and it almost perfectly tracks the OSP. You see allocations coming off here, And that's when OSPs were really getting high
Mm-hmm.
because we had the steep backwardation in Dubai structure, and then Dubai structure came off, and OSPs got chopped aggressively as we discussed last week, and now we've seen allocations rebound.
So we can show the OSP chart as well, right? The OSPs to Asia. So this month, for May, they've come down aggressively, more than was expected, and then combined with the flat price sell-off that we've seen, we know China likes to buy on a low flat price.
Paying $70.
Exactly. So low flat price, lower than expected OSPs. That means that China's got a lot of motivation to buy crude while it's cheap. But then there's also maintenance season coming up. So
Yes.
in May, sources that we've spoken to expect perhaps 1.8 million barrels per day of Chinese refining to be out of action for maintenance. So you've got to ask, where is that crude going to go? Probably storage, right? It's cheap now. Get it in, store it, then run it once you've got your refinery back online. So I think this China demand story is probably quite a temporary one. That is simply perhaps the result of this confluence of factors coming together at the moment. But Will, do you have a different
Well, it's the
opinion on that?
elasticity of
Yeah.
price as well, right? I mean, at the end of the day, like as you say, the Chinese like to buy when outright prices weaken. That's just a generic thing that's always been the case. And how do you define that? Well, you know, a 10-15% decrease in the kind of average of last year would be seen as, you know, weakening prices. But they're in such a perpetual state of needing so much oil. You know, it might be they might have less demand, but they still got enormous demand, and they do like to kind of store quite a bit opportunistically. And they have, you know, a lot of all the refiners there are selling in a different way to Europe, right? They've got like official selling prices on an outright basis of all the products domestically, you know, plastics, gasoline, diesel, anything. So when prices go lower in crude, the Chinese refiners are in a great position because for a time at least, the domestic prices stay where they are, and the crude leg needed to buy the feedstock to create those products gets weaker. So they're just making more money. So naturally you get a demand increase from the refiners. But this is where it's like, what is demand? Is demand about the end user? Or is demand about, you know, making money ultimately for refiners and the people who are producing it? And they're the ones buying the crude. They're the ones with the demand. So it's very easy to get choked up in, oh, what's the Chinese economy doing? It's like, yeah, but what is the Chinese oil industry doing? I mean, that's quite a big deal as well. And that's effectively what you're saying. So you're saying it's actually quite bullish for the time being, at least on the demand basis. But then at the same time, the Saudis are producing more, OPEC are producing more, and they're selling at low prices, even to the benchmark, to kind of get that market share. So it kind of nets out, right? I mean, I guess you could talk now about the Dubai window, which is where, you know, the physical gets tendered to actually settle the price every day. And it's a very good indicator. You know, those out there listening, a lot of people know, some people might not know. You've got to look at this public available information about what the traders and made houses are doing at these benchmarks, because every day there's a tendering window saying, these guys are saying, I want to buy, I want to sell at this price. That's what the officials are tracking. That's what they're commenting every day on LinkedIn. We'll put a link here for people to go check it out. There's some great commentary about it as well. But guys, what are you seeing in the physical window in the last couple of days in line with what you're saying with China and all that?
Well, the physical window this month is still dominated by VTOL on the buyer side, really, because they're still buying an enormous amount of crude. So yesterday, for instance, they got another 2 convergences, and this is seeing the physical premium gradually pick up again. It's been a bit choppy over the past few sessions, but it is generally on an upward trend. So
okay, but again, for listeners, right? So why would VTOL be doing that? Why would oil? I mean, VTOL are an oil trader. There's Glencore, there's Trafigura. These guys' job is to deliver it to different regions around the world. So the VTOL are buying a hell of a lot of oil in the physical window publicly, and they're converging it into real cargoes. They're probably buying on behalf of China, right? That's kind of their job, right? Where the demand is, they supply it. So that would be an indication of exactly what you're saying. It's supporting your thesis that actually the oil traders are buying it up to deliver it to China. So that's what I'd argue there.
Yeah, and I mean we've seen that in the past. You know, a lot of traders in the window will declare cargoes out to China. TOTS was plenty. That was those cargoes were delivered into China. We're also hearing that there's cargoes being delivered into India as well. So perhaps there's a pickup in oil demand there. But yeah, Asian oil demand is certainly not looking as bearish from our perspective as many people are suggesting.
All right, guys, thanks for that. Very thorough. And again, you're going to be doing loads of videos, explainers, what you're talking about, a very crucial area. So thanks again, and we'll catch with you guys next time. Okay, back in the studio. Let's start talking about who's made money this week, right? So this is the gold rush.
So I'm going to talk about the M1380 crack. So that's high sulfur fuel oil, the Asian high sulfur fuel oil crack. So just looking at price action, if you could get just looking at my chart over here, the M1, that is the month ahead Sing 380 crack, has been rallying all week. So it's currently at like $1.50 $1.50 per barrel. And this might be, just going back, it's definitely a recent high, if not an all-time high made in this crack. So I think that's really significant. Now, from the fuel oil desk and from our own dashboard as well, we've seen that Chinese physical players and Middle Eastern majors and NOCs have been long the contract. So they've been long for their natural hedge reasons, but they've made a lot of money from the paper market as a result of that. So that'd be my focus for this gold rush.
Yeah. Harry, let's also talk about, again, this was in the first week we did this. We called this the Widowmaker. If you could zoom out again, Mita, just on that graph, because if you go back a few weeks ago, that price rise, I guess, what was it? This was, when was it? I think it was the beginning of March.
Yeah.
We had a price tick after it coming off quite a bit. So we went from kind of gap down from kind of like
this is a rolling chart.
If you
So
wanted to
it was
the April contract.
It was the March contract which hit the all-time high.
Understood, but it had come off even on a rolling basis. In like the cracks were starting to weaken. People started to pile into this trade because a bit like the MOPJ, a bit like the Brent Dubai, the historical normals weren't there. So people were kind of fading this to get into historical normal. So a historical normal for a 380, which is the Asia shipping fuel contract, right? The fuel oil contract. Again, we're talking like -8, -10 even.
Yeah, between -8 and minus. Yeah.
So we're at very high levels, and people are wanting to get stuck into that on the short side. They all got burnt, right? There was about 4 or 5 big trade houses who made a lot of money there. The rest of the industry and fuel oils have got a lot of volume in it in the world. Got destroyed, right?
A lot of speculative volume as well.
A lot of speculative volume. And so what happened since? Kind of people, basically licking their wounds, taking a while to get back. The market has continued to rally, but now the people who got burnt being short are now getting long, and everyone's now long, and the market's going up. So that's why we call it the gold rush, because everyone's making money. So who's providing that liquidity on the sell side? Well, most likely refiners, right, who are just hedging their refinery margins. Now, again, to not labor the detail too much, but everything on a refinery margin is done products minus crude. Now, fuel oil is usually negatives. There's usually a waste product. And again, we talked about this in the first week. So it being towards positive or more than positive means that you're making money by generating fuel oil, which is insane, right? It's meant to be a waste.
And so usually your high sulfur fuel and your Naphtha are your kind of loss leaders on your margin, and they weigh down the margin. So
for them to be high, refiners love going in and hedging them, right? So they need to go in and sell.
You're not trying to make money from it. You're trying to just
not lose,
basically. So if you can hedge a fuel oil crack at -$1,
you're laughing, really.
You're laughing. You've got nothing weighing down your margin. If you've got gasoline cracks at 14, gas oil cracks at 20.
So the refiners would have been more than happy lately to be providing that kind of sell side liquidity for the speculative volumes to buy and make money. So kind of everyone wins there.
Definitely.
Because you're not really talking like the zero sum game, because the refiners are happy, the speculators are happy, the market makers are kind of providing liquidity.
And this is what we've been talking about at the beginning. Like, this is what we would define as a good market. It's relatively orderly to make money. People are doing well, albeit having lost a lot of money early March. But still, it's a bit of a reprieve for the fuel oil traders.
And you can really see, just going back to the chart again, you can really see the bullish impetus in the market. So these, where I've circled basically, those candlesticks, if you can see, are really long bodied. You can see prices going from just rising all day. That's called a bullish Marubozu line, bullish Marubozu candle. And that's usually symbolic of
what candle?
A bullish Marubozu candle. It's a Japanese term.
All right.
And that essentially tells you that the market has conviction in this trade. Like people want to get long, which I think is really exciting. It is obvious. It is, of course, a bit concerning that the last candle over there, but that's just today's candle, has started off with just a lot more with people trying to put prices back down. But I think it's important to see that they weren't successful. Prices went back up. So I think that this is a strong market. And so the ADX, this line at the bottom, shows the trend strength in a market, and that's rising above 20, also showing that this bullish trend is strengthening, which I think is a really good.
Yeah, it's a good indicator. But we're now talking. What is it?
It's sort of like redefine. I think it's also the cool thing about the fuel market now is it's kind of like going to redefine expectations, because even before, like when we had this happening on the March contract, you had this, like we said it on the first podcast, it was so localized to March, that the March April time spread for 380 was at kind of 5-6 times its usual high,
indicating it's an outlier, right?
Whereas now you've got structure. Yes, you have some like punchy numbers on time spreads, but it's not, they're not like $30 or whatever. You've got positive cracks and a structure which doesn't look, so stupid. That would
suggesting that it can last a while.
Yeah, and even like the forward cracks, like the summer cracks, which are usually quite strong off of the like Middle Eastern demand in the summer. I guess now that things are positive, it kind of opens up the market for these kind of moves to like.
Well, this is what I was going to say. Like, back to Mita's chart, you could join in on this trade at all-time highs, and it's pretty dangerous in the sense that from a price perspective, historically, you're like, oh, what's your upside? But having said that, if you can find liquidity and you can ride it into pricing, this is the difference with these contracts to futures. You can let that expire, and once it starts expiring, this is when the derivatives start mattering less and less, and the physical starts dictating. In other words, it can stay high in a situation where people genuinely want the physical. And just been reading anecdotally that a good fundamental reason for this is actually in 2020, the entire shipping industry had to move to low sulfur fuel oil, and this is high sulfur fuel oil for a kind of environmental kind of reasoning. And so people had to buy a different fuel that was incredibly expensive. But because the premium of this new fuel was so much, it's basically taken a few years. But in 2025, we now have most ships basically saying, no, I'd rather buy the technology to buy the cheaper stuff, convert it into lower sulfur by these scrubber exhausts, and basically have cleaner fuel cheaper. And so that increases the demand for the high sulfur fuel, which has probably caught the physical market unawares, not enough supply, and the price rises like this. But I was going to say, rather than necessarily join this trade, which you could do, and like Mita says, it's exciting. Harry, you're saying it's so bullish for the refiners because they're not wasting any money running fuel now, so they can go in and buy crude and just make a lot of money, which is very bullish the crude market. Basically,
I was going to say you quite often see this kind of strength feeding through to like DFLs.
Which is the Dated Brent, which goes back to the beginning, the basically the Brent time spreads and the Dated Brent market.
So on average, as you can see over here, our average entry level prices for the past week show that longs entered around negative 65 cents per barrel. So
and what was the long short split? How long are we talking?
So we
scrolling up last 7 days.
The last 7 days had around a 70-30 long short ratio.
And overall?
And overall the overall is a little more short as well, but this is over the life of the contract.
Yeah, and that's going to be the net result of all the refinery hedging flow out there and all that.
So this just shows even more so how significant this turn upwards is.
Okay, so the last 7 day entries have just really cleaned up. So the 7 day entry price minus 65. Sorry, continue. And the price is where now?
So with that entry level at around negative 65 cents a barrel with the target. So for example, putting a target of 85 cents a barrel for these.
Well, that's where it is now, or that's where you think
so
it's all profit
it's around 1.5, it's around 150, but just to, we've done the calculation for 85 because that's where it was, that's where it was yesterday, and we assumed that would be like a normal target that people might have put.
Okay, so making roughly like $1.
Exactly, they wouldn't necessarily have assumed it would go above $1. So I'm assuming that as a target right now. So looking at our 7 day net long volumes, and comparing them with open interest and our average entry levels, we estimate that the market could have made around $14 million from this over the past week. And that's considering 85 cents as the target, not the current $1.50.
I reckon that's a very conservative estimate because that's just one contract as well. So you've got people would have been long European crack as well. They would have been longer time spreads and probably like crack rolls, like all these things you can do. But, 14 million just on that $1.50 move. You could probably now double that because it's now like 150. So you're looking at like I would estimate it probably more like 60, 70
gonna
million
say,
has probably been made in the industry on that,
Yeah.
on just the last 7-day move,
Yeah.
right?
Yeah.
We're not talking about buying it at -5, which a lot of people had
Exactly,
as well.
yeah.
So entry levels for the past 90 days were around -2. So you can imagine.
Oh, there you
that,
go.
Yeah.
Yeah.
But lots of money being made.
And it kind of like compounds if you go then on like 10 days ago, you go time spreads, forward cracks, like
Yeah.
barge cracks. Yeah, you start getting into like 200, $300 million.
Yeah. And for context, a big trade house, a big year in fuel oil would be 100 million, right? For
Yep.
fuels. This is probably making some people's years.
Absolutely, yeah,
already,
yeah, yeah.
It's quite early on in the year for that.
Yep.
Yeah.
And then it's always the question, what do you do if you make 100 million at a trade house? Like, oh, I could make 200 or I could lose it all.
Yeah.
And I don't know, it's probably they would say probably one of the harder parts of the job. What do I do now for the rest of the 6-7 months?
Yep.
Or more. Anyway, that's very good. But I think now, like we talked about Brent, right? Ultimately, Harry being a decent trade on the back of like the fuel oil economics. Again, that's gold rush, right? Because the industry, as we were saying at the beginning, has definitely been long Brent time spreads, long contracts like the DFL, which are very linked. It's the dated Brent minus Brent differential for like kind of spot markets. So yeah, so that's been making the industry money. And it was something that was such a flag for me. As we were selling off from, the 70s down even into the 50s, the front Brent time spread, you guys, everyone's got to look at the front Brent time spread, right? Because it's an indication of real physical health. Like it basically can't go that low if the market is okay, because the entire like North Sea, like oil trading community will just buy any size. When I say any size, I mean, they'll literally buy like 100,000 lots each. You're
Yep.
talking about they will buy an incredible amount of volume if the prices justify it. So what you could see as the prices were cremating was like very steady volatility down. It was just unbelievably resilient, which basically, and by the way, add fund rolls to that. So fund rolls have got an open long position for passive indexes and they're selling that and
Yeah.
buying the next month. So that's a time spread trade. That was getting absorbed as well. And the sell-off, that was like a glaring indicator that
Yeah.
the underlying market is very strong and also that the trade houses want this contract. So when like prices kind of went on their way back up to the mid 60s, I think the most obvious trade in a way for the industry would have been the front Brent time spreads at +40, and now it got up to I think 78,
75%,
yeah,
yeah.
it's now back up mid 60s. But we're talking like a really, really nice, ironically low volatility move, despite all this mayhem in the outright prices.
Yep.
So I think you've got to say that that's an industry maker. And now you add the fuel economics getting better and better. The refinery margins are getting better and better.
Yep.
This could be like a pretty decent explosion to the upside of
Yep.
Brent. So now, I mean, we need to crack on because it's been great, but there's so much detail to go through. What about people losing money in the last week? So this is the Widowmaker. So Mita, what are we going for kind of the main contracts that people have been losing money on?
So we're gonna go for the M1 RBOB crack, which so just looking at this chart over here, this was the past week's price action, just right there. So prices moved from, as you can see, above $21 per barrel to a low of around $18.50 a barrel. And while jumping up from there on the 14th, as you can see over there, they're still sub $20 a barrel. On the back of this price action, we saw institutional financial players stop out around these lows, around the 9th and the 10th, which took price action to its low of $18.50 a barrel. So I would say this is the Widowmaker for this week.
Yeah, I think that's actually very fair because, Harry, we've been talking about basically a bullish game for gasoline for the last 4 weeks. And a good proxy for gasoline in the global market is the RBOB contract, right? And I think retail traders will be more aware of that, more generic traders.
Yep.
So US gasoline versus Brent. And that has, I mean, been rising in the last generally. So you would expect if people are long Brent or people are long in general, they're going to be long this contract.
Yep.
So that's kind of not severe weakening, but definitely risk off. Yeah, it would have hurt people. That's fair, right?
I think it's interesting that despite rolling up over here, it's still prices are still below the 10-day moving average. So that might still be a short-term resistance level for price action.
Okay.
Yeah, interesting.
So it's interesting to see when a moving average flips from support to resistance, which is what happened into April for the M1 contract, for the M1 crack. And it's still pretty significant that this 10-day moving average is at $20. So that might be a significant level where we could see selling.
And this would have been part of that kind of wider tariff-induced like de-risking, basically, like along with oil flat prices. A lot of the funds would have been in RBOB flat price, RBOB cracks. A lot of US players would use this as their way of speculating gasoline. So this kind of stop out and sell off would have definitely been caused by this sort of general like just dumping of like risk assets, basically.
Yeah, it's weird though, because I think it's been quite resilient as well, but then to all of a sudden sell off. I mean, who knows? But I hear your point.
Because you saw EBOB holding up a little bit better against it.
Yeah. So the European gasoline. And this is where, I guess, again, another like point we need to make. US gasoline is definitely the benchmark for global markets. So things tend to price off it. Now, the European market prices off RBOB. So the RBOB versus EBOB differential is, you know, quite liquid. A lot of volume trades it. It's very important to hedge voyages between the regions. So people use that, right, to get in and out of the European risk. So they've been buying the arbitrage, haven't they? Or I guess you were going to go through this in the deep dive, Mita. Maybe you could just follow it on.
Sure. So yeah, so the deep dive for this week will be on the M1 EBOB crack. So just to go on to that. So as you said, the EBOB crack has been holding up strongly, especially recently compared to RBOB. If you just look at risk in itself with open interest, I've got that chart up there as well. So towards the end of March, around this bit, so on 27th March, open interest was at 12.5 million barrels, which was 30% above the 5-year average. This, while open interest is still above the 5-year average, it's just 3% above this average. So you can really see this convergence towards 5-year averages at a time when we should be seeing more risk in summer gasoline. So that I think is interesting.
That is interesting, right? Again, because we've been talking Q3 as like market piling in. So there must have been a de-risking event.
Yeah.
Definitely. Yeah. I heard from like chatter and also from just our dashboard as well, we saw that majors were cutting length at this period. So we definitely saw majors stopping out, which was interesting. And we also see trade houses trimming their length against Onyx, just again on the chart over there.
Yeah.
So yeah, they flipped.
So it's brought back the open interest to kind of around the 5-year average. That's what you're saying.
Yes, it's just 3% above the 5-year average.
Okay, that's massive, because that means, you know, we've got a lot of room to go for the market to be risk on in a traditionally bullish contract.
100%. Yeah. And if you kind of normalize it, like 5 years ago, you know, this market has matured quite a lot in 5 years in terms of volume. So for it to be like at the 5-year average, if you normalize that, that's like probably quite underweighted in terms of like volume.
So if you're bullish, I mean, that's a good contract to be kind of.
Yeah. I mean, and you've kind of cleared out some length now. So if the market is kind of looking now at summer and you've got more capacity to go long.
Yeah. The only thing I would say though, like, given what we're saying, the fuel market's being so strong, refiners probably indiscriminately buying crude and probably hedging as much as they can as well. That does provide a lot of sell volume into the product cracks, right?
Like what has to give kind of thing.
Well, as in like if a refinery is looking at the forward curve and being like, God, look at those economics. Like ahead of time, if I can go and hedge this all, basically selling all the products, buying all the crude, I'm going to make a lot of money by running my refinery. I don't want to miss this. They're probably going to up their volume of hedging soon, or if not already. And, you know, as much as the market might want the volume at very high levels, it's kind of vulnerable, right? So maybe that's kind of, in a way, a bit of a red flag. And if the demand isn't quite there, I don't know, in the long run.
Yeah, it's true. I don't know. I mean, that could have led to some of these, that could have induced some of these stop outs as well if they saw
especially majors who were like, actually, we got refiners. To hedge.
Yeah. So
I still think it comes back to Brent then, right? It comes back to crude, because if refiners are going to go in and hedge, that means they're going to guarantee their production at very high rates, at very high utilization rates, which means the demand of crude is going to be there. So I think the one thing that this is just keep pointing to bullish crude, really. And people might say, well, if the demand isn't there in the long run, can it hold up? Well, this is the weird thing. It's about refiners. If the refiners have guaranteed their utilization rates by hedging forward at as much as they can, they don't care if prices weaken, because they're going to be making money on the hedge, and they like running their refineries at high rates because you know, everyone's getting employed, everyone's making money. It's a big deal to start cutting rates and firing people and all that. So I think that is very bullish, the underlying crude market still, and I have to keep saying it. Yeah,
agreed.
Is there anything else you want to say on that?
Yes, so just to dive a little deeper into EBOB. So as I said, we saw trade houses trimming their length against Onyx. And then interestingly, at the same time, we saw trade houses at buying the front month TAR, so that is the US gasoline versus European gasoline bench differential, which could be another way to get short your the EBOB crack, essentially.
It's been adding to the de-risking, I guess.
Exactly. And I think that's interesting about OTC markets, right? When you don't see that channel, you can't sell EBOB itself. You go through these other vents or these other outlets to get into your or out of your position.
You have to be aware of the web, right?
Exactly,
Basically. Yeah, no, that's a very fair point. Okay.
Interestingly, just going forward for EBOB, we see trade houses, just to put up the chart again, we see trade houses adding length again to EBOB. And this just dials into what you guys were saying as well, that there's just so much more room in this contract for people to go long at a time where summer gasoline sees a surge in demand. So I think that could be interesting that trade houses are now buying again. So I think that's something that we could maybe look into this early on, like right after a sell-off or right after the...
And the story's there for them to be maybe getting unusual hedging from their internal side. They need to hedge on the sell side, but then their spec books want to buy. Yeah. And we know they do it all, right? So, I mean, that could justify...
Do you think that they see like a lower flat price environment going into the summer as being generally quite constructive for, like, you think how sensitive like the US consumer is to retail prices? If you've got like a significant decline in retail prices, do you think they see that as like...
Well, I know that Trump does.
Because Trump does, right? It's all he talks about. So if you're coming into...
it's like a tax cut when the gasoline prices get lower.
If you're coming into driving season, you know, if you want excuses to be long gasoline going into the summer, you've effectively got... I know we don't love to talk about flat prices so much, but if you have a lower pump price in the US, the US fucking love driving cars, right? Like you make something cheaper, you generate demand.
I completely hear you. And look, I mean, I don't know, this is very speculative, but again, if there's that whole America first thing going on, tariffs, you know, people want to stay locally for their holidays. I mean, the thing like US, they got every kind of season, like they got everything you'd want to do. And that's why I guess holiday season for them is all about driving.
Yep.
I mean, you might even see a concentrated domestic demand. So US gasoline in particular, I'm with you. Relative to WTI prices and Brent prices, gasoline can perform very well in summer. I'm completely with you.
Yep.
But I think that's a good time to speak about the forward looking stuff, which is the crystal ball. So we do Onyx Beta, which is basically looking at 4 contracts as a reflection of the overall market. Again, it's not all about the outright price, Brent or WTI. It's the differentials as well. So let's look at Brent. Let's look at the front Brent time spread, the European gasoline versus Brent crack, and the low sulfur fuel oil versus Brent crack in Asia. That's our summary. Yeah, last week we were bullish everything, I'm pretty sure. And I think generic, there's been a bit of volatility in the time spreads now, but ultimately I think, generally speaking, those have all played out. The only thing I'm not sure about is the Asia very low sulfur fuel oil crack. Do you have that there? But whilst you're looking at that, generically speaking, it's been a hot market, a bullish market for the underlying market, and even the outright price on a week to week basis. So where do we go now, do we think? It's a bit more uncertain, right?
Yeah, I still feel like VLSFO should be supported. Like gas
with fuel being so
fuel,
strong.
like high sulfur fuel's been strong. Like there should be some relationship there. Gas oil is not doing too badly. So I don't see why VLSFO would sell off. I mean, demand's pretty inelastic. So yeah, I don't see an argument for that selling off. Same with the EBOB.
It's kind of got the trend. It's going. I guess the only thing is refinery margin selling.
Yeah, right? You could get some margin selling, but I don't feel like that will be. I don't feel like they would want to sell into it like aggressively.
They'd want to be selling at good target levels, not selling it down. I guess I can see your argument there. Yeah. Amita, you agree?
So for VLSFO cracks, we see that the market is net short against Onyx. It's just we have seen a trim in this net short positioning, which could explain why prices have also been rising that much. It's just that when you look at price action, it is interesting to see that that while, especially the ADX line at the bottom over there, while throughout this time of this rally that we've seen into April, the ADX has been declining, which I think is a concerning factor in my opinion.
Sorry, what's been declining?
The ADX, sorry, I'll just explain again. The ADX is that last, this basically is the ADX, and the third panel over there. So that measures the strength of this trend that you're in currently, but your prices are in currently. It looks at the average up moves and down moves and measures whether this current trend, whether it's an up move or a down move, is strong or not. So it's still above 20, which signals that there is some potency to this bullishness. But the fact that it's declining while prices are going up, I think is a bit concerning.
Okay.
That said, momentum is still positive, and we have seen buying, as I mentioned. So I think it should be supported. I do think we could maybe see like a correction in the near term, but I think for now, I think we're going to see the buyers try to defend their positions.
So I guess the going back to the herd mentality, you know, again, the Iranian talks, if they start to become more productive, you should see actually price weakening potentially in the outright price. But again, if the underlying market is so strong, I don't think that's going to be the case with time spreads. And you know, I don't know. I mean, it's a bit more uncertain this week. I think. Well, I guess playing it safe by saying just ride the trend, right? Bullish kind of across the board.
Yeah.
A bit more tentatively, I guess, in the products because of the refinery margin hedging. But
yeah, potentially, yeah. I mean, flat price, yeah, like you say, it's a bit tough here. Brent spreads, like I still would be bullish. Just I don't really see any change. Maybe
yeah, I think crude is our highest conviction one, right?
Yeah.
What we call the structure, right? Time spreads and the DFL and Brent Dubai. You know, pretty constructive. Anything kind of Brent related, I guess.
Yeah.
I think on crude, if you just see my chart over here again, so this is looking at Fibonacci levels from the low of 2020 to the high of like 2021. So we had to go back because we are currently in the 650s and 60s range, so we had to go back to those ranges. Anyway, looking at Fibonacci retracement levels from there, we see this concentration of support around the 38.2% level, which I think is pretty significant. So I think we should be supported around this level, and therefore I agree with you there. I think we should be supported here.
Okay, cool. Okay, we've got our answers there. All right, let's end it with, I guess, an organic trade idea. I mean, what do we think is the standout trade? Kind of hinted at it quite a few times.
Yeah, it feels like it should be something Brent related, right?
Related, yeah. I think maybe given that we're coming into the middle of the month, you've still got time to be long the prompt time spread or even the one after that, July, August, again, summer, refinery margins looking so good. Even if products start to weaken, the crude demand will still be there given the refinery situation. Yep. So yeah, you've still got levels. I think the last expiry price in the Brent spread was into the triple figures, so like 120-ish.
Yep.
We're at like 60 cents, kind of been hovering around that level between 55 and 75 last week. So that's still a lot of bullish upside. That would be my take. And again, from a tradecraft perspective, can you just get up the M1, M2? Yeah, we've actually been higher at the beginning of the year. You know, we got up to 85 on the June-July spread in particular. Big sell-off, retracement on the back of all the flat price sell-off. But as I said, it's been very resilient. Like the kind of lows we got to 35 very like briefly. I think a lot of people thought if given the flat price scenario, that should be in contango. But again, the underlying market was there. So it rebounded very aggressively. You went up from 40 all the way up to 80, 85 again. And then, okay, we've got quite volatile now. The volatility, I mean, look, that's going to be probably off the back of profit taking after, I think, the industry doing quite well.
Yep.
And when you profit take on a time spread that's got so much volume, you know, we're talking many multiples of what trades on the outright price. Yeah, there's a lot of volume to shift through. So I would say like volatility around these levels would make sense from a profit taking perspective.
Yep.
But I think we're due another uptick. I mean, if the trade houses in the North Sea, if they liked owning crude oil at, you know, $1.20 differentials, which is what the time spread expired to last month, that is very strong, but it's still very strong. The refinery margin is still very strong. So why would it not carry on roughly around there? Like this is a big discount. It's almost like a carry trade.
Yep.
So I think from a tradecraft perspective, you're kind of entering around here. You're going to have a decently wide stop because of the recent volatility.
Yeah.
But again, if you're talking like a 30-cent stop,
you can always set your stop on those kind of low points where they are, which is still like around 35 cents.
Yeah,
that right, which is about a 25 cent per barrel stop.
That's a good point, actually. But I think even if you go 30 cents, which would be, you know, 30 cents, you got loads of room, if you like. So if you could buy kind of where it is right now with a kind of 30 cents as your stop, you've got basically a trending trade just to let it ride. The thing about this is you're a bit time constrained, right? Because 1 week before expiry, if you're holding big volume, you need to reduce it. There's actually expiry limits. But if you run it right up to expiry, you've got what, two weeks of a trade. So I think the scaling stuff is a little bit dangerous here because you're going to kind of run out of time for the trade to breathe. So you want to put on the kind of your max size relative to your drawdown kind of straight away and just ride it. That would be. And then I guess your profit taking as close to his expiry as possible, because that's when the physical most aligns to these prices, and the whole base of this trade is the physical market strong. So that would be kind of like my general take. All right. I think we'll leave it there then, guys. That was really great, and thank you for all the detail and commentary. Just for viewers out there, look, we talked about a lot of stuff. I just wanted to mention again, the officials is on LinkedIn. You got Jorge Mentepeke, who publishes the report twice a day, and the team is supporting him there. Please go check that out. You've also got on Onyx Markets, we've got a lot of educational material there. Things we're talking about, speculating, hedging, different counterparts, even tradecraft, how to speculate. That's all there. I spent a lot of time building those pages. Please go check them out. We'll put the link here. And again, as always, check out our content in general, flux.live, onyxmarkets.co.uk. There's plenty there for you to get stuck into, to trade, to get these Flux graphs we're always talking about. This is selling this very cheap. It's actually free if you have an Onyx Markets trading account. So we're trying to make things as accessible and as educational as possible. So please check it out. And again, thanks very much for listening. Can't wait to hear your feedback, and see you again next week.